Your mortgage is up for renewal, you need to refinance, and you want to consolidate some debt, and you can't see a way out. Yes, my friends, all this and more with our good friend and mortgage broker, Mr. Dion Beg, right after this. Here we are, my friends, back with our favorite mortgage broker in all of the land, Mr. Dion Beg. How you doing, my man?
I'm well, Gary. How you doing?
I'm excellent. I feel like summer's here. I don't know where you are in Canada. However, we are seeing some nice summer weather. And most importantly, I was just talking to a realtor here, and many of you know I'm in the Kelowna, Okanagan area. I was talking to a good realtor buddy of mine here just the other day, and he goes, Garrett's the strangest thing. Yes, I have listings that are sitting on the market. Yeah, we all seen those. However, we're starting to see, now mark my words here carefully, just a few things going into multiples. Not over asking, but just a couple of people coming out of the woodwork. He's saying slightly more buyers. And all that means is if you were working with 5 buyers last week, you might be working with 7 buyers this week. That's all his comment was. We're just seeing a little bit of forward momentum, Dion.
Yeah, and I'm noticing the same. The number of pre-approvals that we have in our pipeline is improved. It doesn't mean that all these people are going to buy tomorrow, but the fact that they're actively sending in their pay stubs to get pre-approved means that yes, these are real buyers ready to go buy.
Yeah. And again, careful what I say, and don't take it to the don't take it to heart. Say, oh, Gary said we're in multiple offers. No, I was just looking at some stats in Stouffville, my old hometown, and for detached homes, it's creeping up to 7 months of inventory there for detached homes. So everyone has their own local market where they purchase it. We've talked about this over and over again, Dion. Make sure you are working with mortgage broker and realtor that understands your local market and all the differences that goes along with that. I was looking at some stats earlier too, Dion, about the number of power of sale listings that are on the Toronto Real Estate Board now. Yeah, it's higher than we've seen the last couple of years, but we are seeing those homes also sell. So we're not seeing that type of inventory sit forever and forever. We're starting to see just slight increase in movement. I think that's my message here today.
And just on the topic of power of sale, I actually have a client right now who purchased a power of sale, and we spoke about this briefly last week. But we did coach him and say the property needs to be in good standing, like physically looking good, structurally, health-wise, all that other stuff that we look for, and it's going to fall into that category. So yeah, he's actually buying that directly from a bank.
There you have it, my friends. So Dion and I will spend some considerable time on what that's like. I purchased them personally. Of course, I purchased them for clients that way. I've helped and mentored listing agents on how to take those types of listings. So from a real estate or realtor standpoint, tremendous amount of experience there. And of course, Dion has tremendous amount of experience in financing those types of purchases. They are not a 1, 2, 3 step. There's about 18,000 steps when it comes to those. We'll get into that very, very deeply one call. Dion, we had a question from our video last week, and here it is simply. I know this is off topic. Can I finance my down payment with a line of credit? So let's maybe fine tune that question a little bit. I believe what our friend here is saying is, hey, I want to go buy my primary residence. Can I use an unsecured line of credit to go do that?
Yeah, and I guess the reason for the question is it's very hard for people to save nowadays if they are renting. With the cost of living and the cost of shelter, it's hard to squirrel away a couple of $100 a month in order to save that down payment. At the same time, you could walk into your bank today and get a unsecured line of credit for $10,000, $20,000, maybe $50,000. And so that's a logical question. Hey, Dion, if it's going to take me years to save for a down payment, could I actually just use this unsecured facility to act as my down payment? So the answer is technically, yes, you can. But I'll also say that I haven't actually successfully funded a deal in recent years where we've had to use the down payment from borrowed funds like this. And I'll tell you why. It comes down to the debt load and how banks look at the debt service ratio using that as your down payment. So let's say, for simplicity, that we wanted to put down $50,000, okay? And you happen to have that available on a line of credit, okay? So you borrow that money out of your personal unsecured line of credit, use that for down payment. Now, your actual payment on that might only be $100 a month, okay? So let's just call it $100 a month just to make the minimum payments, to make sure you're not paying extra interest on interest, you're paying the minimum. Now, even though the payment to the bank is only $100 a month, the way that the lenders force us to use a payment for that particular borrowing is they force us to use 3% of that amount as the monthly payment. So 3% of 50,000 is $1,500. So if you were going to borrow for down payment and we declare that, I have to put $1,500 per month into your liabilities. And that 1,500, put simply, guys, it reduces your mortgage qualifying by $300,000. Okay, so in the same way that a $500 car payment drops your borrowing by 100 grand, a $1,500 payment on a credit card or unsecured line of credit will drop your mortgage borrowing capacity by 300 grand. So, while it's technically possible, it's so much harder to qualify on the other side that it really doesn't make sense.
Yeah, I like it. And you kind of sets us up perfectly for the theme of today's call, and that's all around, preparing for refinance, preparing your long-term standing when it comes to your relationship with money and finances. And one of the things that, Dion, you mentioned to me before we jumped on the call here was if I've got a mortgage renewing later this year. I'm not talking about next month where I need to be talking to you right now. I'm talking about October, November, December, end of the year. Should we be calling you now? And you told me an amazing story of, yes, this is why when you're 6, 8, 10, even 10 months out or more, we need to be contacting you.
Yeah.
Lay the land for us. What have you been able to do for one of your clients?
Sure. So we had a client who's coming up for renewal in October, so several months away. And he actually contacted us back in February or March. So, quite a long lead there, more than 6, 7 months out, he's closing. And he said, Dion, I'm with a B lender right now. I'm self-employed, but I'm making good money. The problem is right now I owe about 20 grand to the CRA, which a lot of self-employed people do. When they do their taxes, they then write the check. So I owe 20 grand to the CRA. And I've also accumulated a little bit of consumer debt. And when we looked at the numbers, his credit score was in the low 600s. Okay, it was in the low 600s. So if he was trying to refinance to a major bank within the following month or two, we really wouldn't be able to help him. But what we said was, okay, because he contacted us early, we had enough time to put in place a plan that would allow him to refinance in October to a major bank. Okay, so what we did was we got him a second mortgage. So he left his first existing mortgage in place, which is with a B lender, an alternative lender. We got him a second mortgage. With that second mortgage, we paid off his CRA debt and we paid off all of his credit cards down to zero. Okay. In the months that followed, his credit score has since boosted because we're monitoring the credit score over the next couple of months. And we know that come August, which is when we want to submit the deal for refinance in October, closing October, his credit score is going to be well and truly into the 700s. He will have paid off his CRA debt, and the debt ratios are going to be good so that we can take him to a major bank. So that's an example of where if you do a little bit of planning prior to your renewal, we can clean that stuff up and move you over to a major bank.
I like it. It's sometimes, as we don't know what to ask, but we should have the right knowledge in a sense. Go talk to the professional like Dion in this case. That, my friends, is the most important thing to do. You might not know how to look at your current financial situation, or you're analyzing an investment property and you're like, man, I don't know what to ask or don't know what to do. This is a perfect example of just reaching out to the right expert and saying, what do I do? What do I need to do? That is incredibly
And
important. Yeah.
I can understand how clients feel overwhelmed with scenarios like this because for them, it's the first time in their life that they've had to deal with this question. And I think, the benefit of dealing with professionals who in that particular field is that we have seen this situation dozens of times. And so when you bring us what you feel is a very unique circumstance, we can say, I understand how you feel and why you feel that way. But the good news is we've done this 15 times in the last year, and this is what we can do for you. So, it's exciting when we get to talk to clients and show them that, the thing that they're trying to solve all by themselves just needs a little bit of extra information and experience that will get them the solution they want.
I like it. I like it. Okay. Let's jump down to the massive savings and what as well. Almost the same storyline in a sense, but with a couple different tweaks in a different scenario. Creating, when someone has other debt or credit card debt, the different things you can do to help consolidate that and what that looks like.
Yeah, so we had another family contact us a couple of weeks back. They'd worked with a mortgage professional last year who had got them a mortgage, but they were still struggling. And they were struggling because even though they had a decent mortgage, they were still carrying about $140,000 in consumer debt. So we're talking credit cards, lines of credit. Gary, at a guess, do you know what the average credit card interest rate is today?
Oh, we got to be over 20%. Yes.
Yeah, so she was carrying on average at around 26%. Okay, so imagine having 140 grand of debt at around 26% interest. That translates to something like $40,000 a year in interest. Okay, just on credit cards. And so when we looked at her numbers, we did realize that yes, there was an opportunity to roll in that debt into her mortgage, and we went through that process. Now, because she just got a mortgage last year, there was going to be a penalty on the mortgage that she had. That penalty was $15,000, and for anybody listening, that's not a small amount of money. It would be like, well, why are we paying 15,000? Well, we're paying 15,000 because on the flip side, when we did the math, the saving on her interest on those, that 40 grand a year in credit card debt, that was going to save her about $110,000 in interest over the following years. And so the question was, would you pay 15,000 in order to save 110 and be $95,000 better off net? Of course, the answer is yes. So that deal actually just closed today. And I know that family has a huge sense of relief. And not only are they saving the interest, but on a monthly basis, their household is better off by $2,500 a month in cash flow.
Wow.
Yeah.
Wow, that's a big chunk of money. I love stories like that in the sense that there are ways out, and just knowing who to ask and what to ask, that type of thing. Okay, we've often touched this. Maybe every 4 or 5 months, people come to us and ask us about pre-construction and things like that, and there's lots of opportunities everywhere, and a lot of people saw opportunities in pre-construction a few years ago. And as you know, when you buy a new home, with condo, detached, doesn't matter, you're not closing typically next month or in 3 months from now like you do a resale home. You're closing sometimes in 1, 2, 3 years or more. And over that time, my friends, the landscape typically changes when it comes to valuations and how banks look at funding those types of properties. Walk us through some of the things that you've been seeing the last little while.
Sure. So just last week, we got a deal where a client purchased a property, paid $880,000. The appraisal came in much lower. We knew it would, based on recent sales. The client knew it would as well, and we were whenever I get that appraisal report emailed to my inbox, I always kind of hold my breath, right? It's like, okay, and I click on that button and I go, okay, how much is the damage on this? So the client paid $880. The appraisal came in at $715. Okay, so it's a huge difference, over 150, 60 grand. What we did there was we went and got access to equity in his principal residence to make up that shortfall. And we were able to get that approved, and that will close in the next week or so. But that's an example of many that we've had to deal with this year. Another one, the appraisal came in fine. The appraisal came in fine, 1.375 million. It's a detached home, so 1.375. And the problem was that the client was hoping that they would have sold a different property in advance of buying this one. Okay. And what happened was that other property did not sell.
Mm.
And so because of that, again, we had to go through this situation where we had to access equity in that other property through the form of, this wasn't actually a second mortgage. This was actually what they call blanket finance, where you take one loan, but you blanket it across two properties as to act as security. And in doing that, we were able to close that deal. So, things don't always go as planned, and when that stuff happens, it's really important to have multiple funding opportunities in place, right? So we make that plan with clients early if we can, and yeah, when we know appraisals are going to come in short, even before the appraisal report comes back, we are strategizing with the client as to what to do and how are we going to deal with a potential shortfall.
Yeah. And the other thing too is, and I find even though, pre-construction and in this case condos, for the context of this, what we're talking about at this moment, condos and everything, we've seen the huge not overbuilding, the building of condos in every downtown core, and for a lot of people that's what they wanted to purchase and things like that. Excuse me. Yeah, I still find we're educating people or even sometimes reminding people that when you purchase a pre-construction condo and you see your closing date, you get all excited. There's a few dates in here, my friends, that we've got to be really mindful of. When you get the keys to your condo, in the real sense of the terms, that's not your closing date. 9 times out of 10. What we have here is your occupancy or interim occupancy while the builder is still finishing other units in the building. That moment might take up to a month to 12 months, 24 months. I've seen it even 36 months later, where the builder now has the opportunity to go register that condo with the local town building department, and it's at that point is the actual closing date. So what happens in the middle? You are not paying your mortgage. And you might say, yeah, that sounds amazing. This is great. However, what you are paying is a lease fee or a rental fee, or the correct term here is an occupancy fee to the builder. And typically that's about the same cost as your mortgage, your taxes, and your insurance.
Yep.
Right?
Sometimes it's actually higher. I've actually seen a scenario recently where a client was paying something like $5,000 a month.
Wow.
And when we got him his mortgage, even after the condo fees and everything was factored in, the monthly dropped from $5,000 to around 3,500. So it was actually higher under the occupancy period.
That's incredible. Well, let's use that $5,000 as an example. And typically occupancy fee, interim occupancy, if we even just use a 12-month scenario, you're paying that fee for 12 months, $5,000 a month, $60,000 a year, and there's no mortgage pay down. You haven't even started your first mortgage payment yet. So help us understand. Sorry, pardon me. My question is, help us understand, if you get a 25-year term or amortization, and a 5-year term, at what point does that actually start, Dean? Does that start at the final closing date, so maybe 12 months from now?
Yeah, so the technicality is the builder is still building the property, but your particular unit is livable, habitable. So they're going to give you the keys, and they're going to say, you can occupy the property or you can put a tenant in the property. Whatever you do with it is up to you, but you're going to have to pay us an occupancy fee, and you don't have any choice at that point. This is the way it works. And even though the elevators still have plastic wrap on and the hallways still have cardboard down on the floor, congratulations, this is now your property to occupy, right? The builder, just understand this, the builder still is carrying the debt that they borrowed from the big bank, let's just call it, say, RBC, who funded their building. So every month they have to pay RBC. And they're like, well, if I have the opportunity to collect $5,000 from this person to pay to RBC every month, then they're going to do that. So that's why they do that. Now, the building cannot be registered with the city with, let's say it was one piece of real estate and now there's 300 units. Those 300 units can only be registered with the city as individual units when the building is fully complete. And that's called registration day, where, one title becomes 300 titles. And once that title becomes clear, that is when you can actually take possession of the ownership of the property. And ownership of the property is when I can actually then register a mortgage on the property. So yes, you're right, Gary. That could be as long as 2 years from after the occupancy date. And we still need to be prepared for that. I will say something interesting that's happened in the last couple of years, which we didn't really need to do before. At the time of occupancy, let's say you got your occupancy coming up next week, the builder is now often asking the client who purchased the property 2 years ago with a piece of paper, so I'm going to buy it. Before they give them the key, they're asking the client to prove that they still will get this mortgage. Okay, so now we're getting a lot of requests from clients coming to us, say, Dion, my occupancy is next month and my closing is in 12 months. But in order for me to get the keys, I actually need a letter from me or our brokerage to say that I will qualify for a mortgage. And the reason for that, Gary, is I've actually heard some crazy horror stories of builders letting buyers occupy the property, and then 6 months later, building gets registered. So that's when the occupant now needs to get a mortgage, and they can't get a mortgage. And now the builder's trying to evict these people from a property that they've moved into. And again, this is all because of the change in lending guidelines and what happened over the last couple of years, making it more difficult for people to qualify. So, yeah, there's some crazy stories out there in relation to pre-constructions right now.
There you have it, my friends. There's always lots of moving parts when it comes to financing your real estate purchases. Always, as we shared today, why it's important to talk to Dion and his team. Remind us how people can get a hold of you.
Yeah, at kangamortgage.ca or Instagram at the Dion Beg.
There you have it, my friends. That's the Dion Beg. Of course, I'm Gary McGowan. We'll see everybody in the next episode. Goodbye for now.